Of the market, and today on Markets at Lunch we have a very special guest. Sunil Singhania, head equities at Reliance Mutual Fund, joins us live in our studio. Sunil, hi, afternoon. How do you feel at 5,500 for the markets? Does it seem like Indian stocks could stall from here onwards, take a breather, or is it time that investors should now consider taking profits or deploy more money?
I think first of all, it definitely feels good when the markets are up because it benefits everyone involved, whether it's the investors, us as company, and the economy as a whole. As far as taking profits out is concerned, I think that's more a trader's game. You know, from our perspective, obviously this rally has been a very, very pleasant surprise. But having said that, we do believe that if things pan out, in terms of the macroeconomic factors which are now getting in favor, as also the steps which proactively the government has been taking, that definitely seems to be more legs, from a longer term perspective. So I think, I don't know about the trader's perspective, but from an investor's perspective, it remains, it makes sense to stay invested. And, there is no profit to be taken because I think almost everyone has missed out on this rally.
Mm-hmm. It's good to see the smile on your face, Sunil, but so do you believe that we're in the middle of a structural bull run now? Because like you say, the early signs of a rally is when people tend to dismiss it. Everyone's been talking of a correction, which has never really happened. So do you then believe that we are at an early stage of a structural bull run right now?
I think we're always in the midst of a structural bull run which started in 2003-04. What we have seen in 2008-09 and also in 2011 were roadblocks in this structural bull run. So I think our view from a longer term perspective is that once a country enters a structural growth in terms of its economy, the growth continues for like 25-30 years. We have seen that in China, we have seen that in Singapore, and we have seen a lot of other countries. I think in India the actual growth started in 2003. So from our perspective, the structural bull run as far as the economy is concerned is already on for the last 8-9 years. And what we saw over the last year or so, and also in 2008-09 were probably the roadblocks to that structural bull run. So I won't say that this is a new structural bull run in the markets which has started. Probably we had discounted too much of negatives. The markets have run up too fast, you can say, over the last 1.5 months. But again, it's not something which you can say that either way that it's time to book profits or time to aggressively buy. I think we have to take things as it comes. Right now, there are clear signs of both, as I mentioned earlier, macroeconomic factors coming in our favor, as well as a lot of impetus given by the government to again kickstart the economy, which was showing signs of slowing down.
Sunil, how much importance would you give to the recent geopolitical developments in Iran and its possible impact on crude? Because we've already seen a spike up and thereby the impact on Indian equities.
I think obviously crude for India is very, very important because we import a lot of it, and I think almost all our trade deficit as well as our current account deficit is a cause of the huge crude imports which we have. As far as Iran is concerned, I think the things are definitely challenging, but frankly, we as probably almost like anyone else are not in a position to sort of project the oil prices. We failed miserably in the past, and we would not like to make a projection going forward. But obviously, oil prices going forward remains a key sort of a monitorable, and I think that should be definitely looked at by all the investors. Only one point here I would like to make is that the US, because of what they have done internally, is now becoming less and less reliant on Middle East for their oil imports. We read reports and we gather that probably in the next few years, US would be 80–90% self-reliant on its oil requirements, and probably that reduces the pressure on events happening in the Middle East as far as the crude price is concerned. And it is already being reflected in the difference between the two crudes, which has again become $20. So though the developments in Iran are a cause of worry in the near term, probably going forward, Middle East might become less and less relevant, though it will continue to be relevant.
I also want to put the spotlight on the power sector because for the first time in years, we're seeing some serious policy intervention in a sector that's been begging for it, really. The Prime Minister's office intervening, asking Coal India to sign long-term agreements with private power producers. How do you read into this move, and do you see this is just the kind of reform that the sector needed at this stage?
Yeah, I think we are very passionate about the power sector, and we are very positive on the power sector as far as India is concerned. This is one sector where huge investments can be made. There is no problem as far as demand is concerned because we are a power-starved nation. And if we need to grow at 8.5% for a foreseeable future, unless there is power for all, this growth is not going to be possible. So I think the developments which have happened from on the power side are very welcome. They have been very proactive, you can say measures, and the impact is there for everyone to see. One statement from the PMO office for the fuel security has caused stocks to appreciate 10-20%. Overall the market cap of the sector has gone up by like 20-30,000 crores over a matter of one day. And the one good thing is that this time it is not a request. It is basically a direction that you have to do it. It will force Coal India to increase its production because once you sign an FSA and there is a deadline for it to be signed, they have to make sure that they are able to provide coal. Otherwise, they undergo penalty. And obviously, being a listed company, they cannot afford to be short on that. And the other positive thing is that these steps are only the first in the direction of many other steps which are possible. So we are already hearing an EGOM meeting on the UMPP, which is scheduled in the next few days, which will be followed by EGOM on the gas allocation policy. I think this clearly indicates that things are definitely working for the sector, and the government realizes that this is one sector where we have to, as a nation, do everything needed to ensure that the capacities which a lot of private as well as public sector companies are intending to establish, they are given all the support which is needed to ensure that this capacities come on place. Obviously, there are some other reforms which are needed, predominantly on the distribution side, because that will take care of the SEBs. But I think these steps towards fuel security will go a long way in also easing the situation as far as availability of finance, both equity and debt, is concerned. So I think overall these are very positive steps, and this only reinforces the fact that this is one sector where the government really is very serious about ensuring the capacity addition, and from a market perspective, this is one sector which no long-term investor in India can ignore.
But Sunil, I mean, which is your favorite amongst that? Would it be the private players that you're most bullish on, or do you also find value in some of the PSU power companies?
I think it's a mix of developers, both on the public sector as well as the private sector. Obviously, the private sector companies have fallen much more than the public sector, so probably the initial bounce or the initial beta can be in those companies. But even India is endowed with very good, stable, well-managed public sector companies in the private sector, and I think those also are worth looking. From an investor's perspective, you obviously always advise that we have a very good power sector fund, and that is the best way to invest.
Sunil, the other big concern for the sector, of course, is the financial condition of state electricity boards, and that could, in a sense, spoil the party both for the banking sector and for the power space.
Again, what you're saying is absolutely right. SEBs have been under tremendous stress. But one good thing is that they finally realized that they cannot just keep on giving power for free. State after state, so whether it's Rajasthan or Tamil Nadu or some of the other large power consumer states have already increased prices of electricity to the final consumer. And it's, I think, a myth that the consumer does not want to pay a higher price. I think the consumer is willing to pay a reasonable price as long as the availability of power is sustainable, without any blackouts. And that itself has changed the dynamics as far as a lot of SEBs are concerned. Once there are other proactive steps on the distribution side which will cut the distribution losses, we are very sure that the health of SEBs would again be quite decent. And a few of the DISCOMs on the state side are already making very good profits, who have been able to reform themselves. Again, government has been very proactive in giving them funding, to basically modernize their distribution network. And once a few other cities also sort of privatize, I think it is going to raise the level for all the distribution companies to become more efficient. So while agreeing that SEBs are a cause of concern in the near term, but the proactive steps which a lot of these SEBs are taking will ensure that this problem will also be addressed in the near future.
Sunil, what about coal and gas shortage? Because that indeed is a bigger issue in itself. Do you think there is a need for the government to provide incentives to importers as well as private coal producers to tackle this situation? Because Coal India alone can't really help rescue it.
Yeah, fuel security is an issue, and the thing is that we are in a situation where the country has a lot of resources. So whether it's on the coal side or on the oil side, I think there are a lot of resources. I think what needs to be done is to ensure that these resources are efficiently and in a timely manner sort of exploited so that they can be used for the development of the country. So whether it's Coal India or other coal producers, I think we have probably one of the largest reserves of coal in the world. I think we just need to push, whether it is through incentives or whether it is through ensuring that the approvals are on time, to ensure that this coal comes out in a timely manner. And I think this FSA, which has been mandated by the PMO's office as far as Coal India is concerned, will ensure that the production of Coal India, which has been languishing over the last 2-3 years, actually starts to move up. And probably even the private sector companies who are sitting on huge coal reserves, if there is a timeline also enforced on them to exploit the reserves and to sort out all the pending small issues which a few of these companies are facing, probably this coal requirement at least will be taken care of. We'll definitely need to import some coal, there's no doubt about it. But the good thing is that even on that front, Indian companies have gone ahead and ensured that they have significant stakes in overseas coal companies. There are a few issues there relating to Indonesian taxes and all, which again government can play a proactive role and ensure that the resources which Indian companies own abroad can also be used for development of the power sector in India.
Sunil, from a broader market point of view, for long market participants, and have been critical of the government, over policy paralysis. How do you read into what has happened over the last 24 hours? About a month ago, top CEOs go and meet the Prime Minister. A committee has been set up. In about 15 days, action is taken, directed by the PMO. What kind of a signal do you think the street needs to pick up from this intervention?
One thing is that we are a democracy, and we are an actual democracy. We are not a democracy for namesake. So I think what has been done obviously has been done taking into account the nature of the country, and we can all argue that more should have been done over the last 18 months, and even we are of the view. But I think the government realizes that they have been slow, and I think the proactive steps which we are seeing from the government over the last 2 months seem to be a trend which looks likely to continue. And there are expectations that there is a possibility of the government becoming more stronger in terms of numbers as we progress over the next 2-3 months. And that might act as another, you can say, a further trigger for the government to continue with this aggressive mood, or probably even increase the speed of the much needed reforms. So I think we continue to be very, very positive, and obviously these steps which are being taken are a welcome surprise, and we are very happy about it.
Sunil, you just talked about your fund. Apart from equity diversified schemes that are available, sectoral funds like banking, natural resources, power or pharma, which of the sector funds are witnessing fresh inflows at current juncture?
As I said, I think the speed of the rally has caught all the investors by surprise, and the investors have probably not been able to participate afresh as far as fresh inflows are concerned. But one good thing is that the retail investors over the last few years have matured. So even when the things were a little bit challenging, we did not see outflows from the mutual fund. So I think long-term investors have benefited. The NAVs of most of the funds, a few of the sector funds which you mentioned, like infra, power and banking, are up like 30-35% in the last 1.5 months. They are now only marginally lower than probably their all-time peak. So I think the long-term investors have benefited. The investors who are waiting for a right opportunity have missed the last 15-20% up move. But for a long-term investor, probably that is nothing to be worried about. And our view would be that whenever you get an opportunity, or whenever you share the optimism from a longer-term perspective, or whenever there are a few triggers which are definitely going to hit the market in the next few months, I think it's still not too late.
Sunil, you sounded pretty bullish on the long term as far as the Indian market is concerned. But what about the year-end Sensex target? Because now already we see several market participants push their targets to as high as 22,000. What kind of level are you watching out for the Sensex by December 2012?
I'll be very candid and admit that even we have been completely taken by surprise by the intensity of the rally. And if you would have asked anyone their long-term target, their year-end target in December, it would not have been more than 16,000–17,000. We are already at 18,000 1 month into the year. Again, we don't have any targets. Neither do we believe that the targets ultimately pan out to be what you expect. But I think this rally has been very swift. Probably there is a view that we might take a pause. It is possible, we might probably react by a few percentage points here. But the difference in the mood is very evident. So from a mood where people were waiting for the markets to go up to sell, I think we have clearly a mood, whether it is domestic investors or global investors, that they're all looking at opportunities of a small reaction coming in the market to invest big time. And I think that will ensure that the market stays stable in the near term. As far as the year end is concerned, as I said, a lot has been done from the government and policy front. We still need a few more steps over the next few months. And I think if these steps keep on coming, there is definitely a possibility of the markets moving up further. On the macroeconomic front, inflation again is below 7%, much sooner than what most people expected. And there is an expectation that, and there is a need for substantial easing as far as liquidity and interest rates in the country is concerned. And I think if that continues to happen, again, that would be another trigger. So I think without biting the bullet and giving you a target, our view would be that keep on watching the small steps which are going to be taken probably and hopefully in the next few months. And you might end up seeing a market which is quite decent.
Sunil, however, what do you think is going to turn out with the budget as an event? And can we expect the government to deliver this time around, or do you think it is going to be a non-event, as has been the case in the past as well, when the market just reacts for one day and then moves on?
It's, over the last, as you rightly mentioned, over the last 2–3 years, budget is becoming less and less relevant from a market perspective, because it is more now a statement on the overall broad macroeconomy, rather than earlier when you had huge excise and customs duty and a lot of companies used to get impacted by reduction or increase in those. However, as you said, this time I think the finance minister obviously has a task at hand. It is a difficult budget to present. We are still as a country facing the problems of a huge fiscal deficit, definitely a problem on the current account deficit. And also the finance minister needs resources through disinvestment, through some other means to bridge this gap. I think this budget from a market perspective is again going to look more from a policy front going forward. So whether it is tackling of the subsidy burden, or mentioning some steps which can long term address these issues of subsidy as well as current account and the fiscal discipline. So I think it's more going to be you can say a policy statement which is going to be awaited. But from a finance minister perspective, I think it's definitely a difficult budget to present.
It is a difficult budget to present, but Sunil, you don't seem too worried by the overall macro environment. But the fact of the matter is that we're probably going to be staring at a fiscal deficit of 5.5%. That's a good 1% over what was budgeted for, and it's unlikely that we'll be anywhere under 5% for FY13 as well. The divestment target of 40,000 crores is not going to be met. That's pretty clear as well. Are you not concerned by the macro factors that are at play right now?
No, I fully agree with you. We are bullish on the market front. We are definitely concerned about all the numbers which you mentioned. But the fact of the matter is that 99 out of 100 people in the streets are concerned about it and are already discounting that fact. And I think from that perspective, unless it is significantly higher from the numbers which we are already expecting, I don't think it is going to impact that much as far as the equity markets are concerned. The other thing is fiscal deficit in 1 year shooting up to 5.5% is fine, as long as you have a clear cut, you can say a roadmap of how you are going to bring it back on track. And that is where I said, the policy statements from a longer term perspective are going to be more important as far as this budget is concerned. US had a fiscal deficit of as high as 9% in 2008-9 because that was the need of the hour. And now as you see, the unemployment there has fallen from 10 to 8%. The markets are at 10 years, 11 years high. So I think all that is taken care of as long as you have discounted the worst, and there is a clear roadmap that this worst is the worst, and from here on there is only going to be improvement. So I think the markets are looking at that perspective rather than the number of fiscal deficit being at 5.5 or 5.4 or 5.6.
Sunil, so what's the Nifty base that you're working at, considering you do feel that it's not going to be just a one-way rally up for the market this year, and we may see pause or corrections as well in the near term? Is 4,500 the clear base, or do you think we could drift lower?
Again, I don't have an answer to it. What I can say is, at the cost of repetition, is that for a change now, we have investors who are looking at the minutest of minutest, reaction to pump in huge sums of money. And I think that would ensure that that reactions, if any, are going to be swift and short. And probably at least this view for the near term should hold. Again, it's a very, very dynamic situation. We are going wrong almost on a daily basis, and that is true probably for most of the market participants. But from our perspective as institutional investors managing funds for 7 million investors, we are more or less fully invested. As we speak, we are trying to see where there is value, where stocks have moved up too fast given their current and the prospective fundamentals, and whether there is an opportunity to sort of jig a portfolio wherever possible. And I think that is where the whole effort is. And luckily, probably we have been able to create a significant alpha. And we are very, very sure that investors who have not made any money from the equity market for the last 2-3 years, probably, if things work out, there is a very good chance that over the next 2 years, equity would again sort of become the numero uno as far as returns on the asset classes are concerned.
Sunil, my final question in this entire conversation, we've completely discounted one piece, and that's Europe. Do you think it's about time our markets also begin to discount Europe?
Europe is a fluid situation. Again, Europe has been discounted by the market at least 100 times. Our call is very, very clear. If someone has spent more money than what they have earned, they will have to bear the consequences of it. So I think the sooner they bear the consequences, the better. I think every day we hear that Greece is agreed to the package, the markets go up. There is now news that Greece has not agreed to the package, the markets go down. So we have no control on what is going to happen and whether Greece is going to agree or not agree. So from our perspective, we believe that we have to definitely look at Europe as a sort of a problem area or a likely problem area. But the signals which we are getting from speaking to renowned economists who track Europe very closely is that in the near term, things will be taken care of. So you might have some interim volatility depending on what happens immediately to Greece and Portugal. But I think at least in the near term, the larger countries are well taken care of. The sort of the QE indirectly which has happened in the Europe has ensured that countries like Spain and Italy have been able to raise significant sums through auction of government bonds at lower than the expected yields. And I think that has given the market confidence. And one reason for this huge rally in risk assets globally has also been to the fact that Europe now looks to be a much smaller problem than earlier envisaged.